Hey guys, Chris from Adapt Tuition here, and in this video, I'm going to show you the solution for question 1 from the May 2023 PoA Paper 2. If you want to see the solutions to the other questions on this paper, I'm going to put a card up there and a link in the description below, so be sure to check those out as well. And with that said, let's get into the solution. So it says, Yahim, a sole trader, owns a printing firm called Yahim Printing Services. He has been recording his accounting information manually, okay? Yahim intends to hire a bookkeeper to assist him with incorporating a software program into his business to make his workload easier. That's a good idea. And to improve his accounting system. That's a good idea. So part 1 to this question is saying, identify one accounting software program that Yahim can use to help improve the business. Okay, so you know me, I can't just give you guys one recommendation. I'm just going to put it up on the screen now. And honestly, I just Googled these, right? To be honest, I just went into Google, type accounting software programs and everything. So Applos, Docket, FreshBooks, Intuit, QuickBooks Online, NetSuite, Patriot Software Accounting, QuickBooks Self-Employed, Sage 50 Cloud Accounting, Sage Intact, Striven, Truly Small Accounting, Wave, Xero, and Zoho Books, right? I have never used any of these, so I can't tell you which ones are good, which ones are bad, but they didn't ask for that. They just said identify, which simply means give a name, okay? If you guys can think of any other accounting software programs, please put it in the comment section below, and let's get some knowledge sharing. Okay, let's take a look at part 2. So it says identify one skill a bookkeeper should possess. So again, I can't just give you one. So I'm going to put up the list now. It says one skill a bookkeeper should possess. So ability to solve problems, attention to detail, bookkeeping/accounting know-how, computer literacy, ICT know-how, good at organizing and executing tasks, good communication skills, integrity and transparency, proficiency with accounting software, and time management, right? Now, honestly, again, some of these I came up with myself, some of them I Googled, and I don't like to give long lists of things, but again, I like to give you guys options because certain things mightn't stick to your brain, but certain things will, and different things stick in different people's brains differently. Anyhow, I'm babbling here. Let's get on to part B to this question. Okay, so part B says the following table shows transactions that were omitted from the books. So we have a little table here and what it's showing. So it says date and transactions 2022, 2nd of April, bought goods on credit costing for, okay. So before I read through all of these, what they want you to do, and let me pull that up here as well, is to use the following general journal to record the transactions from the table on page 4. Narrations are not required. So we're seeing the basic outline of the general journal here. You have your date column, your details column, folio, debit and credit, and this is worth 5 marks. So now I'm going to pull up my format on this side across here, which is basically a copy of whatever they gave you in the paper itself. And we're going to go through the corrections now. So firstly, on the 2nd of April, we bought goods on credit costing $400 from R-True. When you buy goods on credit or whether you pay for them, the account that you have to debit is the purchases account. The purchases account is used to record the purchase, whether on credit, as in this transaction, or for cash, of inventory, stock, goods, merchandise, and only that asset, no other asset, right? So we have to debit purchases, which we'll see here. And we have to credit where it came from. So we bought on credit from R-True, so we have to credit R-True. So you have here accounts payable R-True. Now again, another way to explain why we debit purchases and credit accounts payable R-True is that purchases is an expense. And when you incur an expense, you have to debit the expense account. By extension, accounts payable, right? We credit accounts payable R-True because when you buy on credit, you don't pay for the goods at that point in time. You promise to pay for them later, which means you owe money for those goods. And anytime you owe money to anybody, any entity other than the owner, that's classified as a liability, which when it comes into existence, you have to credit the liability account. So we debit purchases because it's an expense and it's being incurred, and we credit accounts payable R-True because it's a liability that's increasing. Another way to think of it is the little hack I've always said over the years. Credit where it's coming from, debit where it's going. What is it? Well, money or value, right? So we're getting goods from R-True. So you're going to credit R-True. And it's going to the purchases account. We're purchasing goods. So you credit where the goods are coming from, and you debit where they're going, to the purchases account. The next transaction on the 8th of April says sold goods valued at $600 on credit to You Moon. Okay, so this is a credit sale. So of course, if we have a purchases account to record the purchase of stock, by extension, we have a sales account to record the sale of stock. And we will credit the sales account and we will debit U Moon, and I'll tell you why. So again, you could follow the same credit where it's coming from, debit where it's going protocol. So goods are coming from the sales account and they're going to U Moon because we're selling them to U Moon. On the other hand, sales is a revenue and we're earning the revenue, which means you have to credit the revenue account. And we're selling on credit to U Moon. Now, when you sell on credit, it means that the person hasn't paid you yet at the point in time of the transaction, the exchange of the goods. But they promise to pay you in the future, which means they owe you money. Anytime anybody owes you money, that's an account receivable or a debtor, as we used to call it. And that's classified as an asset, which in this case is increasing and requires a debit to record the increase. So we debit account receivable U Moon and we credit the sales account. Okay, the next transaction on the 12th of April says U Moon, so the person we just sold, to return $50 worth of goods. Okay, so when goods come back to us, that's returns inward. So we're going to have to debit returns inwards and we're going to credit U Moon. Right? Now, why? Again, follow this simple protocol. Credit where it's coming from, debit where it's going. So goods are coming back from U Moon. So they're coming from U Moon. So you're going to credit U Moon, and they're going to our returns inwards. So you credit where it's coming from, U Moon, and you debit where it's going, returns inwards. On the other hand, we credit U Moon because, again, we sold goods on credit to U Moon, which required a debit to U Moon's account to record the asset, the receivable. If U Moon is sending back some goods, U Moon no longer has to pay for those goods, which means the receivable is coming down. Your asset is decreasing. And to record a decrease in an asset, you have to credit the asset account. And similarly, returns inwards, that's like an anti-revenue. It's like an anti-sales. Sales is a revenue that was credited when it was earned. So if we unearn revenue, you need the opposite of a credit, which is a debit. So your debit returns inwards and your credit account receivable U Moon. Okay, the next transaction on the 18th received an invoice from B Vic for goods worth $4,000 less a trade discount of 33.3%. Okay, so when we receive an invoice from somebody, that's usually because we made a credit purchase from that person. So we're going to, well, again, so if it's a credit purchase, we have to debit purchases and we're going to credit the person or the entity from whom we are purchasing the goods on credit. Now it says worth $4,000 less a trade discount of 33.3%. Now trade discount is not recorded in the books of accounts. It's simply deducted on the invoice and the net figure, the figure after the discount, that figure is used for your books of original entry and the double entry. So again, I'll say that trade discount is not recorded in the books of accounts. We have to subtract the trade discount first, and the net figure, the figure after subtracting the trade discount, that figure is used for the accounting records. So you're going to find 1/3 of 4,000, which I think is 1,333 and 33 cents. You subtract it, you get about 2,667. Now, again, so the debit is to purchases, the credit is to accounts payable, B Vic, right? And again, you see the 2667, sorry. I didn't bother to put dollars and cents, I just rounded it off to the nearest dollar, okay? Now, the last transaction here is on the 19th of April. It says, goods returned to L. Son. Those goods had been invoiced at $120, less a trade discount of 20%. Okay, so if we return goods to somebody, that's returns out. And we're sending them back to L. Son. So again, the credit where it's coming from, debit where it's going. So the goods are coming from our returns outwards and going to L. Son. So your credit returns outwards, and you're going to debit L. Son. So you're debiting L. Son, and your credit returns out. Now you're seeing 96 there. Why 96? Because the goods had been invoiced at 120, but there's a trade discount of 20%. So you have to find 20% of 120, which is 24, and subtract it from the 120. 120 minus 24 is 96. Okay, right. So there's just one more part of this, to part B. Let's take a look at it very quickly. Okay, so it says identify the source document that was used for the transaction on the 19th of April 2022. Okay, the 19th, that was the last thing we did with the goods return to L. So returns out, well, that is usually accompanied by a debit note, right? Because we, of course, are going to be debiting accounts payable L. Son, so we have to notify them, hey, we are debiting your account because we're returning goods to you. Okay, so that's it for part B. Let's take a look at part C. Okay, so part C reads, the following information is available for 3 of the employees of Yahim Printing Services. So we're talking firstly about employee Layla. So Layla's annual salary was agreed at $84,000 for the year ended April 2023. Yahim has agreed to give her a 2% raise on her annual salary for the new financial year ending 30th April 2024. Okay. Calculate Layla's monthly gross earnings for the new financial year ending 30th April 2024. So her new monthly gross earnings. So first of all, let's pull up some information here. So the first thing we have to acknowledge is that she was earning $84,000 for the year ended 30th April 2023. Now that's the annual, her whole earnings for the whole year, annual, right? If we divide by 12, which is the number of months per year, we get her monthly salary. 84 divided by 12 is 7,000. Now, she's getting a raise of 2% on top of that. You find 2% of 7,000, which I think is 140. You add it on to the 7,000, and her new monthly gross earnings is 7,140. Simple and straightforward. Okay, let's take a look at C part 2. Okay, so now we're talking about employee Samson. Samson is paid $30 an hour. Yahim, so all of a sudden it changed from Yahim to Yamin, has contracted him to work 35 hours per week. For the week ended 30th April 2023, he worked 49 hours. Well, 49 is more than 35, so clearly he works some overtime. Overtime is paid at time and a quarter. Okay, calculate Samson's gross wage for the week ended 30th April 2023. Okay, so we have to break this up into his basic pay, the pay for the 35 hours, and then the pay for the overtime. And then we'll of course combine it to find the total gross. So let's pull up Samson's calculation here. So we're going to start off with the basic or regular pay, depending on how you've been taught to call it. So let's start with the number of regular hours worked, 35 as per the question, and the rate given to us is $30 per hour. When you multiply those two together, you get 1,050. That's Samson's total basic pay. Now we're going to talk about the overtime. So Samson is contracted to work 35 hours per week, where he worked 49. So the difference is 14 hours, 49 minus the 35. And he works for a rate of $30 per hour regularly. But the question said that overtime is paid at time and a quarter, which means you have to multiply 1 and a quarter, 1.25 by the $30 per hour, and we get $37.50. Multiplying the 40 by the $37.50 gives us $525, which when we add it to the $1,050 from above, will give us $1,575. Okay, that's Samson. Let's take a look at part 3. Okay, so it says employee Dolly. Dolly earns a basic salary of $3,400 per month. In addition, she is paid a commission of 2% of the amount by which the revenue of the business, exceeds $40,000 per month. Okay, for the month of April 2023, the company's revenue was $58,000. Calculate Dolly's gross pay for the month of April 2020. So she earns a basic salary of $3,400. Let's pull up Dolly's information here and put in the $3,400. And her commission is 2% of the amount by which revenue exceeds $40,000. The revenue was $58,000. The difference between $58,000 and $40,000 is $18,000. And she earns 2% of that, which in this case is $360. So not that much, as a matter of fact. Right? And when you add those two together, her gross pay becomes $3,760. All right? Okay. And there's one more part of this question. It says, state 2 types of compulsory deductions that are normally deducted from employees' gross pay. Now, depending on the country in which you find yourself, these things could differ. And of course, you know me, I can't just give you 2, I'm going to give you 3. Now, the first and most obvious type for most people is income tax, or PAYE. Then we have health surcharge, which is something I know is specific to Trinidad. That is taken from employees' pay to finance the public healthcare system. And of course, there's this other one called national insurance or social security, which some of you might know about, to help pay pensions and other kind of benefits, death benefits, and that kind of stuff. Right. Anyway, guys, that's about it for this question. All right, guys, so there you have it. That's the solution for question 1 for the May 2023 POA Paper 2. If you have any further questions, please feel free to leave them in the comment section below, and I'll get back to you when I can. If you want to check out any more videos, I'm going to put some cards up here. Don't forget to subscribe, and be sure to check out my website where you'll find some free, interesting POA handouts. Anyhow, guys, once again, thanks so much for watching. Take care of yourselves, and I'll see you next time. Bye.